All right, let's jump right into it. Welcome to This Explainer. Today, I'm putting on my expert investment analyst hat because we've got a seriously fascinating situation to unpack. We are going to run Global Business Travel Group through the ultimate value investing stress test. Why? To see if their massive pending buyout is actually a fair deal. So get ready because we are going to crunch some serious numbers. Here's our game plan. We'll start with a quick snapshot of the company, then we're going to evaluate it using the frameworks of three investing legends: Warren Buffett, Peter Lynch, and Benjamin Graham. After that, we'll dive into a DCF and some alternative models before wrapping it all up with a final recommendation. Okay, part one, the GBTG company snapshot. Let's establish our baseline. Global Business Travel Group. You'll see them trading under the ticker GBTG. Operates a truly massive B2B travel platform. Basically, they provide the software and services that corporations use to manage their travel, expenses, and events. But the absolutely crucial thing you need to understand about their business model is the stickiness. They boast a staggering 96% customer retention rate. Seriously, once a company signs up with them, they rarely, if ever, leave. And that brings us to the valuation challenge we're looking at today. Right now, the stock is sitting at around $9.38, but there's a $9.50 take-private cash offer on the table from Long Lake Management. The company has a market cap of $4.89 billion, and it's trading at a sky-high price-to-earnings ratio of 58.6x. That means investors are paying almost $59 for a single dollar of earnings. But on the flip side, they just reported a massive 35% year-over-year revenue growth for Q1. So the million-dollar, or rather multi-billion-dollar question is $9.50 actually a fair deal? Let's move to part two, the Warren Buffett lens. We know Buffett looks for a durable economic moat, honest management, and manageable debt. And honestly, GBTG checks these initial boxes beautifully. That 96% retention rate plus $3.4 billion in new wins, that is a massive network effect moat right there. Management is also making smart moves, pivoting to AI with their Agencia platform and integrating their CWT acquisition. Debt-wise, their net debt to last 12-month EBITDA is 2.0x, which is totally manageable. Now, for return on equity, we have to make a bit of an assumption. If we annualize their Q1 net income of $54 million to get a full-year proxy and weigh that against their $1.6 billion in equity, we get a solid, moderate 13.4% ROE. So far, looking pretty good. But here is where we hit a brick wall. When we try to calculate approximate owner earnings, which is pretty much Buffett's favorite metric, it gets ugly. Sure, their adjusted EBITDA looks great at $541 million, but their actual Q1 free cash flow, it was negative $52 million. That cash flow is just being dragged down heavily by integration costs and equipment investments. Buffett wants to see clean, consistent cash actually sitting in the bank, and right now, GBTJ just doesn't have it.
All right, part three, the Peter Lynch lens. Turnaround or fast grower?
Lynch is famously all about the story behind the stock. So what exactly is the story here? Are we looking at a turnaround play? A company recovering from the pandemic and temporarily eating the costs of integrating CWT? Or are they a fast grower, fueled by new AI tools that just drove a 35% revenue jump? Well, whatever narrative you want to go with, Lynch ultimately relies on the PEG ratio, comparing the PE to the earnings growth rate. And guys, we have a 58.6 PE sitting right next to a negative 30.7% EPS growth rate. Because their net income dropped from higher operating expenses, the math literally spits out a negative PEG ratio. Lynch loves growth at a reasonable price. A super expensive stock with shrinking bottom line earnings, that's a definitive, unarguable sell in his book. Moving right along to part four, the Benjamin Graham lens. Let's look at strict value investing. Graham is all about the cold, hard math. If we run GBTG through his famously defensive checklist, it's definitely a mixed bag. Adequate size? Pass. They're at $4.89 billion. Moderate price-to-book ratio? Pass. Dividing their $1.6 billion in equity by the share count gives us a book value of $3.09 per share, so a PB ratio of roughly 3.0x. But what about a moderate PE ratio? Hard fail at 58.6x. Graham barely tolerates anything over 15, so 59 would probably make the guy faint on the spot. Now, to find Graham's exact fair value price, we have to use his legendary intrinsic value formula. That's the square root of 22.5 multiplied by the earnings per share multiplied by the book value per share. Let's plug the numbers in. Okay, here's where the rubber meets the road. We take our $3.09 book value per share And we assume an annualized EPS of 40 cents using Q1 as our run rate proxy again. The square root of 22.5 times 0.40 times 3.09 comes out to a brutal $5.27 per share. That is his absolute ceiling. With the stock trading up at 938, Graham would demand a massive margin of safety and walk away immediately, no questions asked. Let's look at Part 5, DCF and Alternative Models. Because the traditional value metrics are struggling with this high-growth integrating software platform, we really have to look at a discounted cash flow model. But honestly, building a base case DCF here is wildly sensitive. Their current free cash flow is negative $52 million. So to justify that 938 share price, you have to make some incredibly aggressive assumptions. You have to bet that the CWT integration works perfectly and that AI drives massive operational leverage. Fitch Ratings says EBITDA margins need to hit the low 20s by 2026 to start spinning out the positive cash flow needed to make this math work. Since a DCF is so speculative right now, alternative valuation models give us a pretty good reality check. Look at this. The median Wall Street analyst target is exactly $950. And the literal cash offers sitting on the table from Long Lake Management? Also $950. Both of these anchor the stock's maximum near-term value squarely at $9.50. The market is telling us exactly what it thinks this business is worth today. Finally, Part 6, Synthesis and Final Recommendation. Let's get to the ultimate verdict. Looking at our analyst scorecard, the strict historical frameworks of Graham and Lynch view this stock as totally overvalued at $938. Graham's math says $527, and Lynch won't even touch a negative PEG ratio. Buffett definitely sees the incredible economic moat, but he's going to sit on his hands and wait for those negative cash flows to turn positive. And then there's the market reality, which puts a hard ceiling on the stock at the $950 buyout price. So blending all of this together, our final recommendation is a hold. Listen, GBTG is an amazing business. The moat is undeniable. But the stock is just expensive. That $950 take-private offer completely caps your upside. At this point, it's purely a short-term arbitrage play. You're just buying it to grab that tiny 12-cent spread before the deal closes. It's not a long-term value investment right now. Plus, the downside risk is huge. If that deal falls through, the floor completely drops out. Which leaves us with one last provocative question to think about. If this $6.3 billion private equity buyout collapses, whether for regulatory or financial reasons, will the market violently reprice this travel giant all the way down to Benjamin Graham's brutal $5.27 intrinsic value? Or will those new AI-driven margins swoop in and save the day? That, my friends, is the multi-billion-dollar question. Thanks for tuning into this explainer. Keep learning, keep analyzing those stocks, and I'll see you next time.